Should you buy property in Australia's most expensive city? The answer may seem like a resounding no, given that property prices in Sydney have continued to increase despite interest rates being the highest they have been for over a decade. But as of July, property prices have only increased by 0.3%, the smallest monthly growth we've ever seen since 2022. So, does this mean Sydney is suddenly going to become affordable for the average buyer? Probably not. However, it does present unique opportunities that may not have been available just a year ago. So, in this video, I'm going to show you what the stats are saying about Sydney's current market cycle, what these unique opportunities may be, and how to establish if you should invest or not. I'll start with what the stats are saying. Right off the bat, I can tell you that the Sydney property market is currently navigating a complex cycle because of two things: slowing growth and market fragmentation. If we look at data from the last few years, you'll see that prices dropped and property values reached a cyclical peak in January 2022 before falling by 13.8% over the course of 12 months. The reason for the steep decline was the RBA's decision to raise interest rates. The sharp rise in interest rates directly impacted borrowing capacity and mortgage serviceability, making it more challenging for buyers to enter the market or upgrade their home. As a result, buyer demand cooled and property prices began to decline. CoreLogic's Home Value Index showed that Sydney home values dropped by 0.1% in February 2022, making the first decline since September 2020. But the Sydney property market began to rebound again in February 2023. This recovery was strong enough to push Sydney housing values to a new record high of over $1.1 million in May 2023, exceeding the previous record set in January 2022. The rebound was quite surprising, given that affordability was still a problem due to a high interest rate during this period. But a few factors were at play, including strong demand fueled by population growth, limited housing supply, and the resilience of the Sydney market. At the time of filming this video though, it seems like data is indicating another period of cooling off. Recent performance data shows that house prices grew by 5.6% over the past 12 months, but growth has slowed down quite a bit to 1.1% in the last 3 months and 0.3% in the last month. When these figures are annualized, they project a monthly growth rate of 3.6%, suggesting a potential for slower growth in the coming year compared to the previous one. But as I mentioned earlier, what makes this market a bit complex is that despite the overall trend of slowed down growth, the market is not actually behaving the same across all areas. Some suburbs, particularly those on the outskirts like Fairfield West, have seen remarkable growth of 6% or more in just 3 months. If this were sustained, the growth would translate to an annual growth of 24%. On the other hand, areas closer to the city centre have experienced price drops. This fragmentation creates a complex landscape for potential investors, with opportunities and risks differing significantly by location. So when you are considering whether to invest in Sydney or not, you have to look at the markets within the market. There are some other things you may want to consider. For example, how resilient the market has been during the period of high interest rates. There are a few factors that contribute to the resilience. For starters, Australians seem to be really good at saving, with people holding a collective $80 billion in offset and redraw accounts. And surprisingly, despite the cost of living pressures, this savings trend has been increasing since March 2023. So, despite higher interest rates, a lot of people have had a savings buffer to maintain their mortgage payments. Supply and demand dynamics also play a role in Sydney's market stability. Monthly dwelling approvals have been declining since 2021, with the most recent data showing a 2.1% drop from the previous month. This decrease in new housing supply, which is happening against the backdrop of a growing population, helps maintain the demand-supply imbalance that has historically supported Sydney's property value. Government policies add another layer of complexity to the market. While the federal government has set a target of building 1.2 million homes over 5 years, it's likely to fall short of this goal. The New South Wales Labor government is pushing for increased construction, but the overall trend suggests that the supply will remain constrained in the near future. Sydney also continues to attract the majority of overseas migrants to Australia, which sustains demand for housing. So, This ongoing imbalance between supply and demand essentially acts as a stabilizing force, making a dramatic crash in property prices unlikely. Economic factors like employment rates also influence the property market. While unemployment is rising, it's still sitting below long-term averages, and with the current employment situation not expected to significantly impact property prices, there's another element of stability to the market. So basically what I'm trying to say is that for potential investors, this market presents both challenges and opportunities. The slowing growth and market fragmentation creates possibilities for targeted investments in high-performing suburbs. Some sellers are dropping prices, potentially allowing buyers to negotiate better deals. The reduced competition from other investors who are potentially discouraged by slowing growth rates could also work in favor of those willing to enter the market now. However, investing in Sydney's property market still requires careful consideration of various other factors. Like, are you financially capable of buying and managing a property here, given the high property prices and potential for further interest rate increases? You must assess your ability to manage mortgage payments and maintain a financial buffer. Your investment goals should also align with Sydney's market characteristics. While the city has historically shown strong long-term capital growth, current rental yields are among the lowest in the country. Sydney houses have rental yields of 2.7% in comparison to cities like Adelaide, Perth, and Brisbane, where the rental yields are between 4 to 6%. If you're prioritizing rental income, you might find better opportunities in other Australian markets with higher yields and lower entry prices. Other than these considerations, if you are going to invest in Sydney, I'm sure I don't need to tell you this, but thorough market research is so important, especially given the massive differences in performance across different suburbs. So, you need to have a granular understanding of local market trends, future infrastructure projects, and demographic shifts. This research should also extend to comparative analysis with other Australian markets to ensure Sydney aligns with overall investment strategies. Risk assessment is another critical factor. You need to evaluate your personal risk tolerance and consider potential market fluctuations and interest rate changes. So, if I had to wrap this all up, I'd say that while Sydney's property market is showing signs of slowing growth, it remains resilient and continues to offer investment opportunities. And with the market's fragmentation, careful research and targeted investments can still yield positive results. However, Sydney's high property prices and lower rental yields compared to other Australian markets still make it less attractive for some investors. At the end of the day, the decision to invest in Sydney property should be based on a comprehensive assessment of your personal financial situation, investment goals, and risk tolerance. If Sydney is not sounding so hot to you, you want to investigate some other markets. We recently did a video explaining why Brisbane and Perth are booming. Go check it out.